Get started?
Yeah. All right, so welcome everybody to Blockshop and to the DC Blockchain Developers Meetup. I'm Patrick Gallagher. This is Victor Rortvedt. And a little bit about me. I'm a resident here at Blockshop. As you guys know, I started out teaching smart contract courses. I see an early student over here. From that and from doing events just like this, I came up with a product and I launched it called One Click DApp. And since then, we've been doing some hackathons, avid hackathon goer, and Victor and I hacked on a cool project called R Token in September at ETH Boston. And if you haven't been to these hackathons, these are really good events. You should definitely go. They're free. They're amazing. You learn a lot of stuff. And so we got so excited about R Token and all that kind of DeFi stuff there that they actually invited us to join the team. So now we're members of the R Token team, which is like an open source project. So that's kind of cool. But in a matter of like 2.5 years, I went from learning myself to now being part of like a core thing. So going to events like this and hackathons, you can really get involved and work your way up and become sort of like an expert in a short amount of time, which is kind of scary, but also kind of cool, right? If you're an achiever and that's what you want to do. Since then, we built a project called R-Trees, which you'll hear Victor talk about. As far as this meetup goes, if you have an idea for an event that you want to host, please ask us. This is for you guys, and one of these meetups is actually where I met Victor. So if you're looking for like a co-founder or something, like these kind of events are perfect for that. I know it's like a small turnout tonight, but usually we have more people. So it might be the location change or just the topic or not as much marketing, but we can always adjust things. And then if you are looking for office space, Blockshop is accepting applicants right now. So, all right, well, I'll hand it over to Victor to introduce himself and get started on the presentation. And then after this, we're gonna dive a little bit into contracts, but we're not gonna go code. We're gonna do no code. So we're gonna look at a visual explorer of the contracts and play around with them. So.
Yeah, great. So my name is Victor Rortvedt. I was a corporate litigation attorney for a number of years before falling in love with blockchain and Ethereum in particular. And so I went to a DEF CON and kind of brain was on fire the whole time. And when I got back, I just decided to get out of law and get into this. And I'm very happy that I did because it's a really cool space and you don't have to be a lifelong coder or anybody that's constantly thinking about either finance things or whatever it is that are the background things. There's aspects within blockchain that grab you in different ways than that subject might outside of blockchain. So it's a really cool open space. And one of the things that I'm super excited about right now is sort of where we are in Ethereum building DeFi, decentralized finance, and the sort of like concept that really makes this thing come alive that we're calling money Legos, which are just essentially stackable protocols that other people build, other people test, other people audit and make secure that then you can build on top of. These things are not proprietary. It's a very different sort of model than I think what people are used to from a Silicon Valley point of view, where it's essentially closing off silos, making a network and shutting the door and harvesting everything inside and not letting people see sort of how it works. The nature of blockchain is that everything is transparent, is visible, and queryable, and so basically building on top of things, having API calls, having contracts that call other contracts functions. This is the whole vision for why Ethereum was created, and the possibilities here are pretty wide open still. And it just feels like we're cracking open a couple of different nuts that kind of we have no idea yet, like how we can explore from there. It's a terrible mixed metaphor, but first off, decentralized finance, DeFi. I just want to kind of start off with a little bit of an open chat. So what does that term mean to you guys? Do you guys have any preconceived thoughts? What do you think of when you hear decentralized finance? You think exclusively about Ethereum and blockchain, or do you think about it in sort of a larger outside of tech perspective? Because in some ways, go ahead.
Yeah, I mean, right now, I feel like mostly, it's used by Ethereum community, but I feel like it can be used by any protocol. So I think we should check it out. Yeah,
and
so I think
it's a little bit sort of going back to square one, but the word decentralized obviously is an important word there. It obviously means it's not controlled by a central authority. There's nobody that decides who has access to the system and who is allowed to do what with it. It sort of has decentralized control over it. So I guess we can kind of jump forward here, but it strikes me that if you think about this concept, there are lots of examples outside of tech here that might qualify. If you think about just like an old school market or bazaar where people were trading using whatever credit system that they've got, essentially, the shopkeepers and people in the market would start to be able to issue credit and start to be able to create these like relatively sophisticated financial abstractions to basically make this economy happen. And that in some ways is very much an example of decentralized finance. It's all these independent atomic actors. Sorry, is there somebody coming to? Who are just looking out for themselves, and they're basically creating the system that works to enable them to achieve their financial goals at the time. And so I think it's not a terrible sort of analogy to be thinking about the emergence of bazaars and markets and things that don't really come down from on high, but people build things that make sense for the people that are using them, the people that want to engage in commerce. And so I think that's one of the frameworks that I think is worth thinking about here. But what's up? Oh, you got it. Okay, sorry. Cool. So money Legos. All right, so money Legos are the cool thing in Ethereum, and I showed, we have actual examples of money Legos here. And they have a MetaMask wallet at the bottom, and then DAI, which is the stable coin created by the MakerDAO process. And then, or Uniswap is underneath there. Uniswap is an exchange that allows you to buy whatever asset you need from a different crypto asset. And then DAI, you can buy on Uniswap, and then Compound is a lending pool. But we'll get into that in a second. So what's a money Lego? What are the characteristics of it? So I just made this up. This isn't any kind of official definition, but I think these are important concepts, right? So permissionlessness. It's a horrible, horrible word that means something very important. And the idea is nobody can tell you whether or not you can participate, and nobody can tell you when you have to leave. You can't kick people out. So almost everything that we've ever encountered in our financial lives has been permissioned, right? Anytime you work with a bank sets the terms on whether you're allowed to do it, and they're also then doing it only at the sufferance of whatever jurisdiction or government they are operating within. So there's always these levels of gating permission, and there's all these controls and surveillance mechanisms that are built in for them to essentially be able to cut off whatever types of behavior they don't like and keep people out that are not within the economy there. So there's things that are permissioned within DeFi, sort of, in the sense that like DeFi isn't this one, you either have it or not, it's not a binary condition, it's a spectrum, much like decentralization is the spectrum. So you've got things like Tether, which nobody really thinks are essentially like permissionless in the same way that the DAI might be. Things like USDC, which is issued by Coinbase, but that clearly then Coinbase has the ability to freeze and recall or somehow render invalid or deny access to certain customers depending on their own terms of service. And so having a money Lego that's permissionless is an incredibly valuable thing, where you don't have anybody that has the ability to turn off the spigot. And so the fact that DAI is created from this decentralized process, it's globally available as long as you have an internet connection, it really is a very valuable thing to have a permissionless money that's out there that no government or bank or even the Maker Foundation can shut down by itself. It's interoperable, meaning that you can connect it to other things, meaning that it's not sort of a closed hermetic system that can't be called or related to other financial protocols that are built on top of it. Sometimes this is called composability. That's the term that people like to use a lot, but essentially it's the Lego part of the Legos. Verifiability is also a pretty key part of this too. This idea that you can actually go look at what is happening. Like when you send a transaction, you have the ability to query it inside of the blockchain protocol that you're using. You can verify, if you're really technical, that the bytecode was correct and that it compiled correctly. But as a much more normal user, you also have the ability to just see if that transaction was confirmed and whether or not that's been gone through the confirmation process enough that other people will accept it as essentially complete. And then with things like DAI, you can verify that the whole thing is actually properly collateralized. You can actually look and see all the collateral that is guaranteeing the system because it's all permissionless ETH underneath. You actually can audit it at all times. It's basically an open ledger that can be queried and verified by anybody at any point. So protocols, that's just a term for these things having their own sort of instructions and the ability to explain to others how to use them and how to build on them. And then for controlling value, that's sort of like read within this whole thing, but it's not just doing all this to be able to update Wikipedia entries, it's doing this to send things that are scarce value around. That relies on cryptography, which we're not going to talk about at all, but of course blockchains are enabled, they're called cryptocurrencies because they use cryptography to enable the transfer of scarce resources and transfer of value on the internet. So, yeah.
So when you talk about like interoperability at this time, are we talking about within the Ethereum ecosystem or like with other protocols?
Well, I think if anybody can build it for another protocol, certainly it would be interoperable. Right now, there are not a lot of great use cases of that, but I don't think there's any reason to believe that there's a technical restriction to that. There's a protocol called REN protocol, which is essentially trying to bring Bitcoin into the Ethereum ERC20 system in a interoperable way. So I don't think that it's any kind of limitation, but there's something that's naturally built in. It's sort of like you're building, on top of inside of the same ecosystem with the same sort of bytecode and the same sort of EVM. So it's easier to build when you're inside of Ethereum. So we go to the next one. All right, so the money ledgers we're going to talk about today, these are not at all an exhaustive list of what's in DeFi, but just for the sake, or just what counts as money Legos, for the sake of just kind of going through this iterative process and showing how they stack. We're talking about DAI, lending pools, and this is the symbol for compound, and RDAI. Sounds like most of you guys are pretty familiar with these, so very quick refresher. DAI is a stable coin pegged to the US dollar that is backed by ETH and is created and maintained at the peg through the MakerDAO governance process using the Maker token economy. It's quite complicated, but actually kind of elegant, and it has been able to hold a peg at $1 since it was, well, there was Psi first, but let's just say that they're continuous. Psi and now DAI have held the peg at about $1 since December 2017, I think, when it first launched, which is impressive because the price of ETH, which is the only thing that collateralized it, dropped 94% in that time period, and it kept it at $1. So then you have lending pools, which are open liquidity pools that, especially with Compound, what's really great about Compound is it's a dynamic lending pool, meaning essentially you get an interest rate. If you have DAI, you can lend it out, and you're going to get the interest rate that changes every block based on the demand for borrowing DAI. And as that fluctuates, as more people want to borrow DAI at higher rates, that lending rate goes up. As people don't want to borrow DAI at those rates, it goes back down. It changes every 15 seconds or so, every 14 seconds on the Ethereum blockchain. It's been very stable recently because of the fact that now DAI has something called the DAI savings rate, which is essentially interest on your DAI. It's sort of like if you have a bank account and they pay you some pittance. DAI has a Maker governance process to pay you for holding DAI inside the DAI savings rate. And now the lending pools, when you're lending DAI out, are using that as this like almost like a federal funds rate. It's like this reference point price that nobody's really deviating too much from inside the lending pools, as long as they're using DAI, because of the fact that that's now like the safe money bet, and so there's just not a lot of variance right now on that. But it's really exciting because you can just go into it and you can come out of it whenever you want. The upside there is you don't have to worry about loan matching, you don't have to worry about loan maturation, you don't loan like 1,000 DAI out and then you get it back with interest in 3 months. You can loan it out at whatever the rate is and then 15 seconds later take it out, right, and get whatever that one block's worth of interest was. That's the shortest period you can leave it in. You can leave it in as long as you want and then decide you want to sort of pull it out of there and do whatever you want with the interest. So that's a really exciting thing, and essentially like compounding these kind of permissionless opt-in at any point, opt-out at any point, lending protocols and lending pools. Essentially, hi, how are you? We're talking about money Legos. These permissions protocols essentially ate the lunch of the other DeFi protocols that were doing loan matching. Dharma was one that did this initially, and essentially, which one? ETHLend, exactly. Like those were just much harder to manage, but now that you have instant go in, instant come out, get the rate that's out there, and that rate is very high. So the DAI savings rate right now is 8.75%. So you can get 8.82% on Compound as of right now, which is wild. And then RDAI. So this is the thing that Patrick and I work on. This goes on top. This is the third money Lego in the stack we're going to talk about today. RDAI takes that interest and separates it from the principal that you put in, and then allows you to redirect that interest, essentially saying we can route it wherever we want it to go. Now you can be really boring with RDAI, and you can use it to just send the money right back into the account that made it. So if you have 1,000 DAI, you can use RDAI and then say, I want all the interest back to my account. But what you're doing is exactly what Compound is. That's what Compound is doing. They're just giving you back the interest. It's the same thing you would have if you had a bank account. The interest comes to you. RDAI is cool because it allows you to redirect it, and it allows you to essentially make this almost like magic money. Because it doesn't really feel like you're spending money if you just say, I want the interest to go somewhere, to pay for something, to donate to a charity, to support an open source project, to give your kid his allowance, whatever it is, or all of those things, because you can choose a bunch of different streams to come out of your interest, all from your DAI. And then that DAI that you have stays in your wallet, so you never lose that original buying power. You're not locking this up, you're not investing it, you're not putting it at risk. You're just saying, I want the interest to follow these instructions. And you can have up to 50 different recipients for each RDAI thing that you're doing. So next slide.
So what are the risks of let's say if you have $5,000 in your bank account, just keeping it there versus putting it on DAI, just to get the interest? What are the risks?
Yeah, there's definitely several risks. So the biggest risk, probably, I think most people would agree, would just be smart contract risk. And the issue in this case is you have multiple tiers of smart contract risk there because RDAI actually uses Compound. It goes in there. And so essentially, if DAI fails, if there's a hack or a bug inside the DAI contract itself, every money Lego on top of it also fails, including Compound if you're using Compound for DAI. And then if you're using RDAI, if Compound has a bug and Compound is leached of its funds, you could be exposed there. So the smart contract risk applies at all the sort of levels of your money Lego stack there, right? So there's definitely some sort of systemic risk that's more intense using these really tall towers of money Legos because of the fact that each one of these points along the chain, along the stack, could be a vulnerability there.
Yeah. And if DAI also loses its peg, that's also under.
If DAI loses its peg, that gets a lot more complicated how that happens because essentially what happens there is they would just have to liquidate all of the resources or all the collateral that are in the DAI maker system. And then they would try to make the DAI holders whole first. That's the whole way it's supposed to work. Essentially, it's got a bankruptcy plan, essentially, and everything is designed to keep the DAI holders whole. Even if the whole thing goes, Fugazi, and they have to shut it down, everybody's supposed to get paid out first in their DAI amount, so you probably don't have a huge risk there as far as if you hold DAI, but there's a lot of things you potentially want to worry about. So one of the things that we have to think about with all this is, just how long have these protocols been out there and how much money are they securing? Because those are essentially the value of hacking it, right? If you can break it and you can take out, right now there's 100 million DAI. That's a lot of money, but that's not $10 billion DAI. And so if somebody actually has a vulnerability and they can discover, they might want to wait and see for it to grow, who knows exactly. But it's one of these things that people have to make their own decisions about their risk tolerance. I'm not advocating for anybody to be putting their life savings into any of these protocols. I don't think you'll find many people in the community that are doing that, but they're really exciting. They have gone through a whole lot of different security testing and audits, and we've learned a lot from various hacks that have happened. And that's not to say there won't be more, and there won't be more catastrophic, but right now it's sort of in the phase of trying to figure out how to make these things as safe as we can. Insurance products are coming online too, but we'll talk about that maybe afterwards. All right, so going back to kind of the framework here, let's just think about two different categories of money, and so what we're going to call idle money and active money. And these can both exist in the blockchain space and in the non-blockchain space, and inside of DeFi and outside of DeFi. So idle money, so these little boxes with the things on the side are representing a wallet or a cache of funds somehow. So the kind of totally traditional meat space world, your grandmother could have put $100 cash under a mattress to store it and secure it, and obviously there are no money Legos involved in that. Obviously she's going to have $100 of cash at the end of a year, assuming nothing happened to the physical cash itself. And in some ways, a stable coin holding inside of a MetaMask wallet or a Ledger wallet or whatever it might be, if you're just holding 100 DAI, you've got a money Lego here, you've got a stable coin, but you're really not doing anything with it. It's essentially just sitting there. It's an idle form of money that's not all that different from cash in your mattress, other than you could spend it in different permissionless ways. But so we go on to the next thing. So a regular bank account that pays a little bit of interest for a savings account actually is a form of active money, even though it doesn't have any of these money Legos that we talked about a second ago. And this is really kind of just really elementary, but it's worth just kind of pointing out to sort of make the comparison and contrast in a second here. What actually is happening when you put your money in a savings account and a bank pays you interest? Let's say you put $100 in, you're essentially lending that $100 to your bank. Your bank is going out and making more money with it and paying you whatever pittance rate. And I think the best rate I found from one of the main banks, not the fintech banks, which are only a little higher. Capital One, it's like a 1.7% high yield account. And that's fixed rate. And so after a year, you get $1.70 on top of your $100. So not super exciting, but this is just how it works. So if we look on to now adding two money lenders together, now we've got DAI and Compound, the lending pools. And so we're in the DeFi liquid lending pools active money form. So we're going to lend out 100 DAI, and after a year, assuming that the rate, now this is dynamic, so this is just like an average, if it was 7.82% APR from Compound, and that was the average after a year, you'd end up with an extra $7 or 7 DAI, 0.82, and that's dynamically calculated. Obviously, it changes every block, like I was talking about a minute ago. So this is pretty cool, but it's essentially the same thing as the bank account, right? Like the way that it actually works is exactly the same. So can we go to the next one? So now we get to our third money layer. Now we get RDAI. Now RDAI, as I said, allows you to redirect it. This is just really illustrating that I described a second ago. So you put in the 100 DAI, like you did in the Compound scenario above, but at the end of a year, you still just have 100 DAI. That's $7.82 or 7 DAI 82 that was accrued, you're not realizing. You're deciding you want it to go somewhere else. And so you're telling, via RDAI, Compound, you're telling Compound, I want you to redirect the interest that I would otherwise be entitled to a different wallet. Let's say you want to donate it to UNICEF. And so after a year, UNICEF has 7.82 DAI, which was your entitlement to the interest, but you're just holding on to your DAI in the form of RDAI. In your wallet, you can roll it back to DAI at any moment that you want to. So this is a pretty neat thing. If we go to the next slide, I think like this kind of describes what I said a minute ago, which is you can redirect it to anywhere. So I bumped up the numbers here to 10,000 DAI is what you would put in. And this is just an example of what you could do. So if you have the same sort of APR rate, you're going to get $782 that are going to come off of that, right? So here's what you're doing. You're actually splitting it 4 ways. You're saying, I want to take a little bit of it. I want to take, and I didn't actually do the math in my head exactly what the percentages would be, but these numbers are important. So this is actually like a real-ish number. Like this is what a year of Netflix would cost, right? So you could say, I want to just pay my Netflix bill with that portion of RDAI. So I'm going to designate a percentage of the 10,000 to send enough interest to Netflix that they need to capture and pay for the bill. Now there's a lot of things that we need to work out technically here, but this is not at all anything other than just technical logistics and them being willing to accept it.
Can you make it a hard number rather than a percentage?
So that's what we do with abstraction libraries on top. Patrick wrote a really great library for one of the hacks that we did called Tribute Utils that is all about using numbers instead of percentages, because one of the problems with it is if you get new money coming in or you take money out, it'll just everything proportionally. So mess up, and people I think in terms of hard numbers, right? Like your Netflix bill is a price. You don't want it to be like scaling to 112% of that or 72% of that based on your balance, right? So, and then like you're also saying, I want 300 DAI to go to UNICEF. That's my charitable contribution here. And let's say you want to subscribe to some newsletters and they charge 120 DAI per year. So you've signed up for a bunch of them. It's just streaming money there. And then you're also keeping a little bit for yourself here. So I don't know exactly what that is, but let's call it a third, a little bit less than a third of the interest there. And this is dead simple to do in RDAI. You're just essentially saying, I want to set these 4 recipients and put in these percentages, right? And so it gets a little trickier when you're talking about actually getting to real numbers and predicting what's going to happen, but those are the kinds of tools that I think we're going to be working on constructing and figuring out how to make fixed interest products inside the RDAI universe so that you can do things like send guaranteed 5% somewhere and that kind of thing. But this is basically like one of the visions of active money, and to scale this up a lot more, and I didn't even build a slide for this because it's too Willy Wonka, but there's a new type of financial independence that's enabled by this. And if you guys can come with me to this imaginary land, imagine a much bigger number than 10,000. Imagine like a 401k number of a 60-year-old person that has been funding their 401k their whole life. Like you're talking about 300,000, 350,000 is like kind of an average amount that people that were funding them have gotten to. And when you talk about that, that's spinning off a lot more interest per year, especially with really high rates like this. And so you can imagine defining your own financial independence as, I am actually actively paying for all the things that support my life. I'm paying for my housing, I'm paying for my utilities, I'm paying for my services that I support, and also donating to charity, whatever else it is. And so you were literally like sustaining your balance and you're paying only out of interest, right? And that's a pretty wild idea that is completely impossible in the Web 2 world, in the traditional finance world. Like, the richest people on earth didn't have anything like Art-Eye, right? They had really cool financial products, and yes, they were making a ton of interest, and maybe they could bulk deposit a bunch of it under very specific, contracts that are drawn up, but they certainly didn't have the ability to fine-tune and program these things and essentially say, I want to go to, 18 different recipients as long as they meet these criteria. So the vision that this enables is a pretty exciting one. And then the upside of it too is that you're talking about a very different financial calculation, right? Doesn't feel like spending when your number stays the same. When you start the year with 10,000, you end it with 10,000. Okay, yeah, you didn't get a lot more, but that doesn't feel nearly as bad as starting the year with 10,000 and then being at 9,200 because you paid for all those things out of pocket. So it sort of greases the wheels of commerce in a new and exciting way. Yes?
So I have a few questions.
Sure.
So it looks like this is another way of digitizing it, a money market. That's what it is, a money market. There's a short term. Is it short term or long term?
However long you want.
Okay.
You go in and out.
So let's just say, who's guaranteeing the principal? And I apologize, I came in late.
Sure, yeah.
And so if you just give me one sentence that's like, how is this guaranteeing my principal back if I want it? In terms of the interest payments, do I get to see where it gets invested or no? And then if I want to bring it back, my interest with a compound. So in other words, put my interest money back and have it rebooked and lend it out again, or is it just a fixed amount I have in, and that's all I'm going to earn regardless of the interest payments sitting in my back?
Yeah, okay, so let me try to take those in order. Okay, so guaranteeing the principal. So there's a couple different points you can look at this, but essentially this is assuming you're familiar with like a cryptocurrency wallet and that you have it in, so DAI, which is this one here, this is stablecoin. Yeah,
Okay.
and it's a permissionless stablecoin that's fully collateralized and you can audit it at all times. You're not relying on any bank, you're not relying on any organization or company to say that they have the money to back that up. So it's all sort of like
insurance. Bank
they don't have insurance. Banks do. Yeah, exactly.
Yeah, that's how I know my principal is guaranteed.
Right. FDIC insurance is a very strong commitment there. So this does not have that. There are potential risks to it for smart contract risk. There are insurance products that are coming online. They're very immature right now, but those insurance products could be one of the things, like an idea people have been kicking around is this idea of a crypto FDIC to guarantee these things. But essentially you have to trust the cryptography to not lose it yourself, and then you have to trust that the smart contract will not be vulnerable, right? And so those things are not perfect guarantees, and as I said earlier, I am not advocating, nor is anybody in the space advocating that people put their life savings into this right now. I mean, this is a sort of an emerging economy and an emerging pattern, and to see the kinds of use cases that I was describing at the end there is quite a ways in the future, and hopefully those number of years will also give more security for things like securing your principal. So the second question, I'm trying to remember, it was...
It's the interest payments. If I put it back into the principal, leaving a part of my principal, will that be worked, or is it just a fixed principal amount that is working off on the interest payments?
Yes, so essentially what it is you can think of it as like it's dynamic and fluid, and all you have to do is just give it instructions. Just imagine your money is this army and you give them instructions, and they're going to keep doing that until you tell them to do something else.
Okay.
And so it's very easy. You have to submit a transaction which costs like in the neighborhood of what, 11 cents, a little less sometimes, that will reset the instructions, right? And the instructions could be as simple as give me all the interest. Stop giving it out to all these other ones, right? And you have all the time, you can do this whenever you want. There's nobody that would decide you only have certain moments in time that you can reset the instructions. This is the nature of these protocols, that they are essentially just following whatever you're telling them to do. And if you say, go spread the money out to these addresses, it'll do that until you give it a different, sort of instruction.
So the instruction is to go ahead and reinvest the money, or is it still a fixed amount? I guess
It's
the reinvestment, I'm sorry if I'm not clear.
So are you talking about compounding in particular, or
Yes,
okay?
Reinvestment of your interest.
Right. Yeah. So this is a big question that comes up a lot, and it's a little tricky to imagine. But
Okay.
so the way compound works behind the scenes is this: you take 100 die, and when you put it into compound, the way that it actually works to give you that interest rate is that they turn it into, let's call it, 1,000 of their compound die. And then as time goes on, every block, it gets information about how many people are trying to borrow and the rates, and they're figuring out this thing that ends up, that what it spits out is an interest rate that we can all read. But what ends up happening is every block, the ratio of your compound die to your die goes down a little bit. So after a while, it's 999 compound die to 100 die. And that keeps going down. And then when you redeem it out, you get more die for your money because you're dividing. So at first you were dividing, the ratio was 10 to 1, right? It was 1,000. Did I say 1,000? Yeah, 1,000 to 100, and then that's 99.9 to 1, and so you're getting more for your die, and that essentially just goes on until you decide to redeem it. So essentially, it is always compounding itself, and it's just growing in this sort of ratio reduction thing. I'm not great at explaining this right now, but the upshot of it is, you don't actually lose out on the reinvesting of compound interest. You're not losing, all those amazing charts you see about the value of 20 years of compounding, and versus if you didn't do that, you're not losing on that. It's basically doing all the reinvestment itself, and the power of each die that you initially invested is growing as time goes on.
Yeah, it's almost like at 12% per year in 7 years, you basically double your investment.
Right.
That's
Right.
And so, in other words, it's reinvesting your interest into it.
Right.
And earning interest on top of that.
Right. Exactly.
So if I understand you right, assuming our die is not in the picture, so when you have this die and you made some interest, if you don't touch it, the next is going to be, instead of $100 getting interest, now you're going to get $107. You're getting interest
Yes.
on top of that.
Exactly.
So another simple 2 or 3 questions. Number one, this is a taxable event when this happens, and the second question is, let's assume more liquidity is coming to this space. Do you feel like the interest is going to keep going up, maybe going down, or it might stay the same?
Yeah.
I forgot my second question.
Let's just do 2 at a time.
Yeah,
Okay. All right, taxation. Nobody knows is the answer on this first, but there are certainly very good advice. So if you invest in something like compound and you retain the interest, that is interest income, especially if you then redeem it to die. The question might be, you might be able to make a good faith argument that if you leave it in compound, it's essentially like gains that have not been realized. But if you actually take them out and redeem back to your die, and you do it over a year and it's within a calendar year, you had 100 at the start, 107 at the end, that 7 is I guess it's a long-term capital gain, or no, it's interest income, never mind, it's not capital gains. So that's the tax answer on that.
I feel like you brought up a very good question, if I could ask you. Since the R die is you're putting control in the individual to redistribute your interest payments. So in the redistribution, do you have to pay the interest payments that you
that you are
distribute out
directing?
to? Does
Well,
that mean it's
there's
been taken out? The
Yeah.
reason why is
You're in control of them, right? You're in control of that
but
funding.
somebody's redeeming them, not you.
Exactly. I mean, again, this is definitely one that has not been answered. I know somebody that feels very strongly that you have the tax liability for redirecting it to somebody else. This also brings up questions of if you direct it to a charity, can you get a 501c3 charitable donation recognition for that? Probably, right? But a lot of this stuff is still uncertain. The tax stuff, of course, I'm not giving you actual tax advice, and there's a lot that needs to be worked out with this. I mean, there's also this question about, well, I'm not even going to get into it, but compound to RDI, is that a taxable event? Hopefully, I don't think so. There's this idea that's out there that there are these things you can do to wrap your die to just basically give them new functionality, and that might not be a taxable event under some people's arguments. Anyway, that's one thing.
This is a different issue, I know, because
Yeah.
it is on the form now. They do ask whether or not
Yeah.
you are in corporate currency.
Right, exactly.
So I understand.
They're usually a couple of years behind. They're all thinking about what people were doing in 2017, and that question clearly applies. If you buy crypto and it appreciates and then you sell it on Coinbase for US dollars, you definitely need to pay taxes on the gains.
Yes,
Yes.
that
Okay.
we
So
do.
that's an easy one to answer.
Yes.
But that was not the actual question. So the second question was, sorry.
Liquidity comes in.
Yeah, what's going to happen?
The interest rate.
It's hard to say. I mean, there's also the argument that more liquidity will drop rates, right? Because then people will be competing for the same sort of users' funds, and there's more out there, and so they'll drop. So I think that we're probably not going to see staggering rates. I mean, this is not for the hodl moon boys, right? All this DeFi stuff is really about like really hyper cool versions of boring grandpa tax or financial advice, right? Like earn compound interest and do smart things with it and donate to charity for charitable tax deductions and this kind of thing. And I think you're going to see some interesting products come online that are going to be much higher risk, that are going to have higher yields, and they might drive a lot of people there because of the fact that it's a higher yield. And I think what's going to be interesting is, at least within the Ethereum decentralized finance fully permissionless area, DAI's savings rate is going to be like the federal, like the Treasury bond
It's
rate.
prime rate.
Yeah,
It's
prime rate, exactly. And everybody's going to be thinking about that. And if you offer more than that, you've got essentially more risk that you're, like coming along with that. It's basically what's up. So I think the other thing that's going to be interesting is when ETH2 comes out and proof of stake starts, and you're able to lock up your ETH to earn returns. It's switching from proof of work where you have mining rigs that are publishing blocks and solving all the cryptography to secure the network. It's going to be moving to individuals that are committing and bonding their own ether into a contract and solving easier problems, essentially. But then they can get slashed if they misbehave, but then they're going to get a return for that. So it's dynamic, but it could be in the neighborhood of 7%, let's call it, for the first couple of years. And when that starts happening for ETH, then I think you start to get more robust ETH lending markets and borrowing markets for people that want to take advantage of those kinds of rates. So I am not an expert at all on modeling that stuff. I have no background in that, but I definitely don't think that we're going to have crazy double-digit interest that's going to be really widespread. There's probably going to be a bunch of it that's going to be kind of niche products, and probably some scams, and probably some bad contracts, and probably some crazy levered products, that are taking things and reinvesting them in longs and like all this kind of crap that like is going to be inscrutable and be crazy. But that's crypto, that's what happens.
I feel like if there is, let's say, the demand for borrowing is there, I feel like the interest rate could still, still be like as high as it is right now, or I mean, I'm not an expert in that.
Yeah.
But,
Well, I mean, like Maker right now has an incentive to like want to really make people stand up and take notice of this, right? So the governance process is decentralized, but they all are like, we have a much better form of money, and one of the ways we can advertise that is by paying people to hold it, right? And so they're actually, the DAI savings rate is basically mathematically tied to the stability fee, the interest rate that they're charging people to borrow DAI. And so as long as people are still borrowing DAI at the rate that they're going, and they can maintain their peg, they basically can push it as high as that the market will sustain it, right? Like it kind of might constrict the supply that's created. Like if they lower it, there might be more supply of DAI that's created. But if they're really trying to send a message to the world, hey, this thing is really cool and valuable, and you can do so much with all this extra interest compared to like, I think like Betterment and the other fintech companies are offering like 2.2% or something like that, which is even better than what the normal banks are offering. But that's obviously a much greater rate that it grabs people a lot. So maybe they will push it up even higher, but at a certain point it starts to feel like it feels dangerous, right? Like you almost are counter signaling if you're saying you can get 14% interest. It's just like, oh, yeah, exactly. That's like speculative. That's like, equity in some sort of company instead of, paying you to hold a stable coin that's supposed to be stable and boring, right? Like, yeah, so.
One suggestion, like, I'll just listen to the TaxBit guy on off the chain. So he was like kind of like explaining which parts of transaction could be liable for a tax purpose.
Yeah.
So just giving it maybe like you can see and you can figure out like where this could be fit in when it comes to like taxation. So,
yeah. It doesn't really excite me, but yeah, I know.
I know.
I gotta figure this stuff out. Yeah. There's a proposal I think for a bill in Congress right now that'll make a de minimis exception for essentially small transactions. It would certainly cover things like transaction fees, and I don't know what the actual number. Do you know what the number is?
It's like $800.
$800. Oh, that's more than de minimis. Wow.
Maybe 600.
Is that like a annual cumulative, or like every purchase under that, or every game that's less than that?
You know you're testing my head.
All right.
Yeah. I'm
'Cause
not
that
sure.
would seem to like be a pretty big loophole if you could just like.
Maybe I'm wrong.
Yeah, but yeah, I mean, I think it's a reasonable sounding thing, and it might be that that's like the annual max that you can use for it. Yeah. So.
So the die is makers now?
Yeah.
How do you like them? Can I?
Yeah, no, I love that question.
Really strong in the past year.
I'm a maker token holder. I've been a fan of theirs, since this is actually when I said my brain was on fire at the DEF CON that I went to and how I came into the space. It was the talk. It was the maker talk there, where they were describing their system, and it was before they had launched. They actually had it called Psi before it was first called DAI, and then they moved it and they converted what was then DAI back to Psi. But they had this like test thing, and I was just playing around with it. I was like, this is wild. This is so cool, because you basically could take, if you were bullish on Ether, you could take your Ether and lock it up and then draw out DAI and like pay bills and have liquidity while still maintaining your holdings of Ether. So that was pretty neat project. And then they had this crazy year last year where their interest rates went to 20% and they brought them back down and then they went back up again. But it's a really cool process because it's all decentralized. They have calls, governance calls every week. They're Thursday at noon. You can find out about them. Anybody can participate and listen. You can talk if you want. You can submit. There's a bunch of forums where people talk about ideas about where they should take this stuff. They have various levers now. They've got the DAI savings rate and the DAI stability fee, and then they have the total market cap of how much DAI they're going to allow to be there. And then the new cool project is using other collateral. So right now it's just ETH, and then they have this other one called BAT, which is like only like 2 million in collateral. It's just this token thing to show you that you can use different types of collateral to generate this DAI. But then they can start to open it up, and we talk about a world where eventually, if this REN protocol works, and you could borrow against Bitcoin and then use DAI, against your Bitcoin holdings, I think that's a pretty wild idea. And then the idea that you have like stocks, if they eventually get tokenized, you could borrow against your Tesla stock or something like that. Synthetic Tesla. I don't know if it, but at some point maybe it's not. Maybe it really is going to be the real shit. But who knows?
Because I heard the guy talk about dead assets.
Dead assets. Okay. What?
Dead assets.
Like what? What's a dead
It's
asset?
basically if you go to a third world country where they have a lot of land but nothing else.
Yeah.
So basically what they can use is use that land, assess it.
Yeah.
That's dead assets.
Yeah.
For government, right?
Yeah.
So they can basically use that and tokenize it.
Right.
That's what one of the
Yeah.
Stephen, I think his name was. He talked about that.
Interesting. Yeah, I hadn't heard about that
Yeah,
kind
that's
of
what
concept,
you're
but
talking
yeah.
about, the alternatives of collateralizing.
Yeah.
That's one of the ideas.
That's like a more long-term idea, I think.
Yeah, well, that's more of an economic development for underdeveloped countries.
Right.
And it's one where I think they're making headways, especially in the third world countries.
Yeah, I mean, Zach and I were talking earlier before the talk started about just like there really is kind of a big difference between the difficulty of wrangling things from the real world and bringing them on chain and making sure that you're getting the right data in and that it's actually a functioning market and there's not some distortions there. And I think those projects are like very, very important, but they're also, I think, like very tread lightly and like let's not get ahead of ourselves right now. I think especially when you're talking about stuff like actual real estate in developing countries, because you're doing a bunch of things there beyond just looking at what you can verify on chain here, which is what starts up.
And that's what they can do.
Yeah.
If you think about it.
Yeah, definitely. But
if it starts to devalue a lot more, then it triggers, the call back.
Right. But that becomes very difficult to imagine. Like if you're talking about liquidating, it means going and seizing physical land.
Yeah.
Do you need an army to do that?
No, but it just it's part of the governance process.
Yeah.
I know.
I think the other way, I'm from Ethiopia, which is like a third world country. So one of the issues, for example, if you're Ethiopian, you can't access like stocks here, let's say Amazon or whatever. So I think synthetic assets can be used for that kind of purpose.
Yep.
I feel like Abra is doing something like this where if you have like a cryptocurrency, you can buy like Tesla or any kind of like.
Well, Synthetics does this now, and UMA is also working on this. Yeah, they're all coming. And so UMA, we were talking to the other day, they had a really cool idea for a product. So they were thinking about doing an index fund. Everybody knows what index funds are? Super boring, but super cool.
Very stable.
Very stable. Well, yeah, not really stable, but very good if you have a long view, right?
Stable
And
term.
what if you used our DAI and index funds, and UMA created an index fund that just gave you index fund, S&P, or the entire US stock market, like VT Sachs on Vanguard, which is like everything, and it has like 0.04% expense ratio, plus 2%, and then UMA takes whatever the cut above 2% is from compound. But think about all the like high net worth individuals that like already are fine with index funds, and then you say, hey, here's a safe way to get an extra 2%, right? It's a pretty cool idea. Who knows if they can actually implement it in a way that's secure, but like that's enabled by this if you just can figure out exactly how to put it together and you recognize that 2% potentially is subject to additional risks, or the whole thing might be actually if you're talking about everything being on chain. But that's a pretty attractive reason to try to build that kind of stuff.
So why does it call Legos? Is it because you can stack one on top of the
Yeah,
other?
yeah. That was like the earlier slide. Exactly. You've got some physical manifestations of them here, and they do stack, and you can compose them together. Sorry, I think I ran long here. Oh no, it's 7 o'clock.
I'm so sorry.
So no, we're good. So I think what I want to show you guys are trees. This is something that Patrick and I built. Do you mind doing it? Because actually, I don't know exactly what your best bet is. So we built something using the RDI protocol. So there's a lot of things you can do with it. I kind of talked about a lot of different aspects of it. And one of the things we built on it is that, like almost all smart contracts, it's a little bit hinky, it's a little bit complex. Pat Duffy's question about can you do it with real numbers instead of proportions, that was kind of hard to wrangle when we were building on it. And so we decided we wanted to build something with it that did something really cool and really new, and that was simple, and that didn't have any of this like wrangling stuff. So we built this site called RTrees. And what it is, it allows you to grow real trees by donating the interest, okay? And we partnered with a nonprofit in Silver Spring called Trees for the Future. They've got a 40-year track record of building like fruit trees and hardwoods and things like that in basically deforested areas around the world. And they have basically been able to do it on average been able to plant 10 trees per dollar donated over their history. And so what we are doing here is we are essentially just creating a charity address for them. And then we are using this RDI system to essentially, what it's doing here, you see these numbers, okay, so these are the 3 things that never change. You can either plant 10 trees, 30 trees, or 100 trees a year. And in order to do that, you need to activate a certain amount of DAI. We use the word activate because it's not invest, it's not lock, it's not risk, it's literally making it active money, like we talked about earlier. And so what it's doing now with these numbers underneath is it's looking at the compound interest rate that's current on chain and pulling it, and when you first load the site, that's not there. The numbers take like 2 or 3 seconds to pop up because it's actually going and fetching them on chain. And it's figuring out at the current interest rate, how many DAI would you need to essentially activate to be able to plant, to generate. So here's like $1 of interest per year, $3, and $10. That's what that really works out to. And so you need 12 DAI to generate 1 DAI in interest at the current rates. And so you can click this, and we have the MetaMask. You got to connect. You got to get more.
I'm on the wrong network. I was on testnet.
It's on the test network. Okay. All right. So we have a platform fee, which is a developer fee. It's estimating your gas fee. The developer fee is really just there as a test to see how it works. So it's essentially sending it to 2 addresses. 98% goes to the charity address and 2% goes to our address to sort of like fund us, and that's like a model that we want to think about like for other use cases maybe that aren't charity, where you would bump that up a fair amount based on the utility of it. So you do all your little MetaMask things, and what it's doing is it's calling the RDI contract, and it's minting RDI, and it's going to say the instructions that we talked about earlier are 98% of the interest goes to the charity and 2% goes to this developer address, and it's waiting for confirmation. We're going to probably have to wait another like 5 or 10 seconds here, and if you get bored at this point, you can go click how it works and read some things, but we wanted to make everything like relatively simple, not get into the really deep things, and use a lot of visual cues to make this a much more enjoyable experience than most dApps usually are. And we really like hid almost all this functionality of RDI. Like we really like shrunk it all down and said, do you want to do this one thing with RDI and donate to these people at these rates and get this kind of impact from it? And so here's some information about it. It's actually our friends here at the Giving Block who are based out of Blockshop. They're some of the original folks, and they were connected to Trees for the Future. They help charities receive crypto donations. It's great organization. They have a lot of relationships here and around the country and around the world. And so we got into Trees for the Future with them. Can we go back maybe and see how? So I think because we switched away, we're not going to be able to see it. But did it confirm?
Well, I'm already growing.
Oh yeah. Okay. So then you go to your grove. It should check if you stayed on that front page. It would let you. It would say, hey, it's been planted, and here we go now. And then go to your grove. And so Patrick has been growing with this one. So he just added 12 die to his activated amount. But now what's happening is, why does it say that?
Because it's not confirmed yet.
Oh, okay. Oh, because you had stopped before.
It's
Okay, gotcha. So he's already grown 2 trees and it stopped before this demo, and this was the one that was left that shows you the fractional amount, and this one will get bigger until it gets to 3, and then it'll move to the background and another one will grow. And when it finally confirms, I don't know why it's taking so long.
I think it takes about 2 minutes.
Ugh,
Yeah.
that's bad.
That's big.
Who built this Ethereum thing? What are we even talking about here? 2 minutes?
They're talking about.
I want ACH. That'll get there
I
faster.
know. That's one of the issues with
Yeah.
Ethereum now. It's the confirmation time.
It's better
Yeah.
than 3 days.
Yeah,
It is better than 3 days though, yes.
That's what we have now.
What
But-
about EOS? EOS is a lot faster. Why not EOS?
Yeah, I mean, if somebody, like the,
I don't think because, I mean, like.
This is definitely a thing. Transaction times
network
matter.
is congested, like.
yeah, and it's like, if EOS can build out a really great multi-use blockchain and they have faster block times, then I think people would migrate to it for sure.
But this should change once the governance changes to hosting, right?
Yes, with sharding, that's one of the things too. It'll drastically reduce the congestion, and then at work, yeah, exactly. There's the put through, the scalability will go up by a measure of 1,000 or so, and so presumably it'll be a lot faster. And then there's also a lot of development of these things called layer 2 chains. So not to get too deep into it, but basically for certain applications, it would make some sense to use one of those, and then it would be able to go like this because it's doing a lot more stuff that's verifying things, and you have to be a little bit more careful with them that it's not trying to steal your money, but.
And the rate of the fees will probably have it higher too.
The what?
The fees.
No, actually, layer 2 chains should be really cheap because a lot of them are basically like things like gaming, right? That requires a lot of really fast interactions. They're making money somewhere else, and so they're providing this super fast microtransaction layer 2 chain, and it's cheap and almost free for the users because they're making money off the users through like in-game assets and whatever their monetization strategy is. So they have an incentive to make that all like super cheap and nobody even notices it.
On the other side.
Yeah, and this is also another thing too called meta-transactions where people can essentially like hide the paying the gas thing from their users because paying gas sucks. And
Yes.
it's annoying and it's slow and it's confusing and it changes, and so all those things.
Here's someone else's grove.
All right, so here's somebody else's grove that is currently growing. Okay, and so it's telling you this person is planting at a rate of 11 trees per year right now. And they also have now these power-ups over here, which are just basically like adding a little bit more money to the thing to sort of give you a little bit of incentive for it to come back, and then you can plant a little faster. We're probably going to build a leaderboard to allow people to sort of compete with each other and sort of see what you need to top as far as the number of trees people have grown, how fast they're growing. And I think right now the cumulative stats, we launched this thing about, I guess, 3 weeks ago, and I think we have about 7,800 die are in it now that are planting trees, and they're planting like 6,000 and some trees per year, which is pretty neat. And they've donated about 300 trees worth already. Oh, wait, here we go.
Here's
Yeah.
our-
So is there any verification or authentication that the trees are actually being planted?
This is amazing how frequently that question comes up. Like
I'm sorry.
everybody, no, it's a great question, but it's
I mean-
wild. I never would have thought of that. That's not something we've ever thought of.
Like fertilize the water and make it grow faster. So
Right.
how will I know that? I mean, I want my dollar to go to good use. I
Yeah.
mean, I care about the earth. So
Yeah,
I want
totally.
to know, right?
Really, all you're doing though is you're just sending money. That's all it's doing, right? That's all.
No,
Like,
that's not right.
yeah, I mean,
But
like,
I think unfortunately, the current anywhere you donate your money, I don't think you can tell whether they for example, you go to Goodwill, you just put
Right.
right?
yeah, and this is the thing. Like, people were giving us like a hard time about this on Twitter, and they were being like, how do you prevent the corruption of the NGO? And we're like, that's not what we were trying to build here.
No,
Like,
but that's the whole point of when we talk about transparency.
yeah,
And authentication, verification, blockchain is able to do that.
Yeah.
So if you're gonna do it through this, and where's the transparency?
well, this is really just this is a money game. This is all this is.
Right, and that, but that problem exists.
Everywhere.
Even without the layer on top, and which is why solutions like Charity Navigator, which is like a thing that rates charities on their effectiveness and all that kind of stuff exists. So maybe you guys should build like a
A widget, yeah.
A widget that shows.
I'm just saying, I know today I don't donate to vodkas unless I know the charity.
Sure.
Because that's the problem.
Right.
So if we talked about blockchain as being an advocate of trust
Right.
and transparency,
Right.
and if you want to donate to this, so how do I know? That's
Right.
all.
Figure out something.
But I've definitely heard some solutions and ideas and like basically protocols for like trying to verify all these kinds of like real world NGO impact things. Like I remember seeing one that was like involved like temperature sensors in the soil and satellite like stuff that was all verified on chain. It's like ambitious and maybe that'll work, but it just seemed like you're trying to build this massive new surveillance infrastructure just to sort of confirm that in fact those beans were grown where the thing on my Starbucks QR code came from. Because like somebody could just be spamming fake data at the last little mile there too for the QR code reader, even if in fact all that stuff is there. So at some level it's very worthwhile to build these things, but like this is not at all what we're trying to do. We're just trying to make this feel fun because like you don't lose any money when you do this. You come in with the money that you started with, and at any point you can hit that stop planting, and you have to pay the transaction fee, so maybe worst comes to worst, you lose like 20 cents or something like that. But then you are basically like stopped and you have your, idle money again. Yeah, so we tried to make this like,
That's good. I like that.
yeah, like not very nice, but also not like mean. And so yeah, you can stop whatever you want, you get your money back, you're not really putting your money at risk, or you're not putting it at risk at all, and it's fun. It's like, not probably my cup of tea, but it's the kind of thing that like a lot of people find more valuable because you're visualizing this thing and then you're doing it using DeFi and you're doing it in this like single serving way. So I think this is kind of one of the ways forward with this is much better user experiences that are abstracting away all this complexity, not saying, hey, here's the RDI interface. Do you want to do all these things and set all these things and control it yourself? Like nobody wants that except for the people that are already in the space that are the kinds of people that want to know what every button does everywhere. So yeah, this is what we're doing.
See you guys. Thanks for
See you
that.
later. Yeah.
Nice to meet everybody.
All right, nice to meet you. Quick question. I don't know, like, if there is any part where your smart contracts, this is sideboarded, like maybe using protocols, you guys have leveraged anything?
We didn't write any smart contracts for this, which is what's cool about it. Like this is just a front end.
Yeah, I mentioned that.
This is just a front end, and so it's got some really cool graphics, and
Yeah, it's
Patrick
beautiful.
Petrie did a lot of really great work on that. But yeah, I mean, we think that's like the way forward. I mean, I remember reading an article the other day that said it's much more likely that in the next 5 years or so, there's only going to be like 200 smart contracts that matter, that people actually use. And so the need for people to write smart contracts and audit them and maintain them will be much smaller because ideally, like, once they do this, they get all the things that you can get out of them. Like you don't need a smart contract for every new thing because if you just are creative about how to use it, you don't need everything to be on chain. What do you really need the trust of a blockchain to verify something for? And a lot of people, I think, overbuild and put way more stuff on chain than they need to, and they're building their own contracts that are just a slight tweak from some existing audited contract that might introduce some new, vulnerability, or they're not as interoperable because it doesn't work the same way, and it just creates more confusion. So I think what we're going to see is this sort of like collapse down to like a fundamental core of like tools that then everybody builds from. Instead of everybody building their own custom solutions, it's just like you make the best damn hammer in the world and everybody agrees that's a great hammer and nobody else needs to build a hammer that has like a feather on it, right? Or something like that. So you use the hammer, and if you want to put a feather on it, go get the feather and, connect those things up instead of writing your own hammer feather thing.
Is that another way of saying governance?
Is that another way of saying governance? I don't think so.
Smart
I think-
contracts is the way, it's just, I think governance is another thing.
I think
Because
smart
it's
contracts
just-
is just kind of like automaton tools. They're just like helpers. They're just like automatic helpers that do special work, like a Roomba, that's good at wiping the floors or cleaning the floors. You don't have to worry about it.
Or it is that we agree to these sets of rules and therefore, follow. If not, then here's the consequences. I mean, that's what governance is.
Yeah.
When you think about it in an autonomous environment, is that you set certain rules and that comes with a contract, pretty standard contracts, and I agree with you.
Yeah.
200 of them would be probably a lot, but for each different cases.
Mhm.
But that's basically governance, if you think about it.
Or-
It's a framework of that.
I hear what you're saying, and I think that there could be an argument that it's essentially like almost shrinking the space of governance by like taking the thing that otherwise would have to be governance and automating it, and everybody agrees that it's neutral and fair and
Yes.
predictable.
Yeah.
But then there are other parts of it that I think are certainly governance in the sense that they have crypto economic incentives. There's this whole field now called like crypto economics, which is essentially
How do you
blockchain
behave?
incentives and thinking about attackers and how do you make it secure and get people to do the things you want, which is like not break the system, but also give people the assurances and settlement finality and all that kind of thing. And so those are very, very important governance things to build in those mechanisms. But then I think you get to this point where it's like they almost don't feel like governance anymore because everybody feels like this is the most like well-tuned neutrally,
Yeah.
or like
Yeah.
credible neutrality is the phrase that they've been using recently to say, this is really good, this works for the purposes and everybody knows how it's going to work, we tell you ahead of time, and it's not favoring any one group over another, and it can't be gamed in any real, or the way that it can be gamed we all accept and understand and prevent in other ways. So I think it certainly relates to governance, and I think ideally, though, it becomes something that doesn't look like governance because it's essentially automating and shrinking the space for where you need governance because of the fact that all these other things everybody agrees are going on autopilot,
I think it's a step further into it, but I agree with you. Thank you for that. I like that word, federal neutrality.
What did I say?
Federal neutrality.
Did I say feral?
Federal.
Oh, federal. I meant to say credible neutrality.
Credible. Okay.
Yeah, credible neutrality.
That's it.
Like
federal. Federal could be good.
Yeah.
I guess I think of government still, huh?
Yeah. Thoughts?
What did
That's
you
actually very good.
did
It's
you
not-
want to show the Explorer?
Oh yeah, also I'm gonna show you the Explorer because it's awesome. So Patrick built this with a guy named Hadrian, and so there are these things, you can't see everything on chain, so there's something called a graph, the graph. It allows you to basically look at blockchain data and pull out other information, and then they built this. This is all of our DAI. This is our trees. This thing is our trees. This cluster right here, this address, this is the charity address. And you can see all these people are people that are donating to it, and you can see, if you stop for a second, you can see all these wires that are going there that are showing you a relative amount of how much interest is going into that charity address. And then it's kind of out of sight right now, but then this is the developer address, and it's fewer balls per line as a frequency than these, right? Because it's supposed to represent 2% of the total, which is 98%. These are people that have all stopped donating, and there's like a weird thing where it's still showing a tiny bit there, but they did it at one point. But then this thing is like this cool mothership that shows you the interest flowing. Isn't that cool?
Yes.
And we are the biggest thing in our DAI right now.
Yeah, so-
Okay. So how did you do that? Is it just through addresses?
Patrick is.
Come on. Oh, so you're Patrick, not the other Patrick.
Yeah.
I mean, it's using an open source library called ForceGraph, and then this is like the 3D version of it. But essentially, it's just a bunch of nodes and edges, like a regular graph. So
So you can monitor that with.
I think I've seen this on Twitter. It's super
Okay.
cool.
yeah, so this is live right now. So this is if I zoom out, this is everybody who owns our DAI is a dot here.
And there's some people that aren't doing anything with it, right?
They're out kind of on the edges of
Yeah.
this sphere.
And this person's just sending all their interest to one other thing.
Yeah, this guy right here.
And I think this is something called LS DAI, which is like a long and short sort of test project that they've got going that uses our DAI. And then these are various charities that go through. So the official RDAI app
That's
has a bunch
this.
of charities that you can donate to.
That's this cluster
And
here.
that's this cluster, yeah. And apparently this works in VR, although we haven't actually tested this yet, but it's supposed to, which would be kind of neat to go in there and move some. And we were just talking about, how we can sell real estate in this, and you can decorate and put emojis on your own node. Like somebody's saying, I want to put a sombrero on my node to show that it's mine and claim it. And you can add various graphics or if you have an ENS name, we'll port that in so you can see that there. But it's a really, really cool illustration of what our DAI really is. And it's live, and it's showing you, this is really cool. Whatever's happening here, where it's passing, looks through this other
It's
cluster.
coming from, it's between, they're
Oh, yeah.
donating to both the our DAO and our trees. So they're in the middle of the two clusters.
So yeah, if you just go to explorer.rdai.money, you can just stare at this thing for
Oh my God,
as long as you want.
that is so cool.
Yeah.
So you can track it.
Yeah, I mean, you can track stuff on blockchain for sure, but we built a specific RDAI Explorer to track it in a different way than would be done on like Etherscan, and then visualize it. Because it really is, programmable interest is like money that's moving. It's not just sitting there. It's not, I did this transaction, stop. I did another transaction, stop. It's,
Here's a simple, kind of a simpler one. They're using the same model with the two different wallets, and the interest is split between this ring in the middle. All those people are splitting their interest between two different wallets, and this is somebody else over here is just sending it to one. So should we dive into the technical
yeah, sure.
side of it?
I'm gonna grab a glass of water.